The biggest banks on earth just changed their silver and gold targets. All of them. Same week, same direction. UP. And the numbers they published are so far above current spot price that most retail investors don't even believe they're real. They are. And I'm going to show you exactly where to verify every single one. I'm Marcus Caldwell, independent market analyst. I track primary source documents so you don't have to. Bank research notes, CFTC filings, LBMA applications, Federal Reserve data. Not what people say about the news. The actual news. Here's what broke this week. Deutsche Bank just published a base case gold target of $6,000 per ounce for 2026. Their upside scenario, 6,900. Societe Generale matched them at 6,000, then added that the figure may prove conservative. Goldman Sachs is projecting $5,400 by December 2026. They described it publicly as having meaningful upside risk. Morgan Stanley's bull case sits at 5,700 in the second half of this year. 4 of the world's 6 largest investment banks, same week. Targets between $5,400 and $6,900. That has never happened in the documented history of institutional precious metals research. Not once. And when Goldman says meaningful upside risk and Societe Generale says may prove conservative, that is not analyst enthusiasm. That is institutional code for one specific message. Our published number understates what we actually expect. Now silver. Citigroup just raised its 3-month silver target to $150 per ounce, up from $100. They published that number on January 27th. 4 days before the market crashed 31.4%. They kept the target anyway. Their reasoning cited further physical tightening in major ex-US trading hubs. That is not bullish speculation. That is Citigroup's trading desk describing what they are watching in real time from their own vaulting positions in London and Singapore. The public forecast is the signal. The private positioning already happened. Before I show you what's happening in the vault infrastructure war, if this kind of primary source analysis is valuable to you, hit that subscribe button right now and turn on all notifications. This channel goes directly to the documents. No sponsors, no conflicts. Independent financial intelligence that institutions would rather you didn't have access to. Hit subscribe. Let's keep going. Here is the story almost nobody is covering. JP Morgan's stranglehold on London gold vaulting is under direct attack right now. Citigroup and Morgan Stanley are both seeking to build vaulting operations in London and become LBMA clearing members. LBMA clearing membership means direct access to the world's largest physical gold and silver settlement system. The ability to hold, issue, and transfer allocated physical metal at the highest institutional level. JP Morgan built its dominant COMEX position from exactly this infrastructure advantage. Citigroup and Morgan Stanley are building the same thing right now. And then there's Tether. $122.9 billion in corporate gold holdings. The world's largest stablecoin issuer just hired HSBC's top gold traders. The most experienced physical precious metals professionals available anywhere in the global market. Hired to compete directly in the physical bullion market. This is not a crypto company experimenting with gold. This is a $200 billion institution arming itself for a fight over physical delivery capacity. The vault infrastructure war is not coming. It is already happening. Now the central bank signal, because this is where the sovereign confirmation sits. CME Group, the institution that operates COMEX, published a survey result this week. 95% of central banks expect global gold reserves to increase in the next 12 months. 95%. The CME profits from trading volume in both directions. It has zero financial incentive to be bullish on gold, specifically. When the exchange operator publishes that number, that is the most credible possible institutional confirmation that sovereign accumulation is structurally ongoing. JP Morgan projects 755 tons of central bank gold purchases in 2026, lower than the 1,000-plus ton peaks of the prior 3 years. But the reduction is mechanical, not structural. At $4,000 per ounce, central banks need fewer tons to hit the same percentage allocation target. The demand is still there. It just costs more per unit now. Here's the detail that most mainstream analysis keeps skipping over entirely. Morgan Stanley ran the math on Western investor positioning. Their conclusion was a single word: light. Western Gold ETF holdings reflect interest rate dynamics only. They show zero meaningful shift toward debasement hedging or portfolio diversification. Then Morgan Stanley published a specific calculation that changes everything. Every single basis point increase in gold's share of U.S. portfolios produces a 1.4% price lift. 1 basis point. And right now, most Western investors have no meaningful allocation to precious metals at all. Sprott Asset Management's CEO, whose entire business is built on tracking precious metals capital flows, described the current moment in one phrase: still early, after a 150% gain in silver in 2025. He sees every dollar moving in and out of this asset class, and he's calling it still early. The capital that has not yet entered this market is larger than everything that already has. Now the full counter-argument, delivered with maximum force, because it deserves it. StoneX's veteran precious metals analyst published one word when silver hit $113 on January 27th. Dread. 40 years in this market, he has watched every major silver rally end the same way. Corrections of 40 to 60% from peak. The structural story did not prevent those corrections in 1980. It did not slow them down in 2011. The specific risks right now are real and documented. Chinese central bank gold buying is decelerating at higher price levels. Rate cut expectations have faded across multiple major central banks. A geopolitical resolution in the Strait of Hormuz removes a key premium from the entire metals complex overnight. And silver positioning, after a 150% gain, is stretched enough that any negative catalyst could trigger sharp forced liquidation. The structural bull case and a 40% correction are not mutually exclusive. They can both be true simultaneously. Position sizing matters more than conviction right now. A staggered entry, not concentrated momentum chasing, is how you stay in this trade through the volatility that is coming. Here is exactly what to monitor. Watch the Asian session open every Sunday evening Eastern Time. That is the specific window where overnight institutional positioning changes before New York opens Monday morning. The January 27th move, gold piercing 5,100, silver hitting 113. Both initiated in that window, not in New York, not during peak retail trading hours. In the overnight session, where the banks move before you wake up. Watch the LBMA for Citigroup and Morgan Stanley clearing membership confirmation. That announcement marks the second phase of the physical vaulting war. Watch the monthly CFTC bank participation report. That number tells you whether institutional silver accumulation is still ongoing, or whether distribution has begun. And watch Sprott PSLV monthly inflows. That trust doubled its capital raise to $2 billion, and is the most direct measure of institutional money moving from paper exposure to physical certainty. 4 of the world's largest investment banks publishing unprecedented gold targets. A vault infrastructure war playing out in London right now. 95% of central banks signaling continued sovereign accumulation. A generalist investor base that Morgan Stanley describes as surprisingly light. And overnight sessions where the banks are repositioning before Western retail investors wake up. The surprise is not that the move is coming. The surprise is how few people understand why it's coming before the market prices it in. This is financial intelligence, not financial advice. Verify every source before you act. If this analysis gave you something the mainstream press didn't, drop the word sovereign in the comments. Subscribe for the next primary source breakdown. Because by the time this makes the front page of Bloomberg, the move will already be made.